People ask me all the time, how's the market? And I'm like, which one? Because here's the thing nobody on the news, on Zillow, or in your group chat is telling you. There's no Orlando market. There are at least 5 Orlando markets. And right now, they're behaving in 5 completely different ways, all at the same time. The headline says the median home in Orlando is $430,000. That number is lying to you. Not a little, a lot. Stick with me. By the end of this video, you'll know exactly which Orlando market you are actually in, what's happening there right now, and why what's happening in someone else's price range tells you almost nothing about yours. Let's anchor the geography first. When I say Orlando, I mean Orlando, Kissimmee, Sanford metro area, Orange, Osceola, Seminole, and Lake counties. About 7,400 active listings as of this spring. Average days on market sitting around 77, and roughly 3.78 months of supply. On paper, that's a buyer-leaning market. But those averages mask everything that actually matters. Whether you're a first-time buyer trying to figure out if you can afford to get in, an out-of-state investor looking at rental math, somebody mid-relocation from Jersey or California trying to time it just right, or a current homeowner wondering whether to list, the metro average tells you almost nothing. Your decision lives in your specific price band, in your specific submarket. Most coverage of Orlando real estate is built on a magic trick. Take 5 different markets, blend them into one number, present it as the truth. We're going to undo that magic trick today. 5 bands, 1 tour. I'll spend the most time on the one most of you are actually transacting in, the middle. But what I want you all to walk away with knowing how your band is actually moving. One principle to hold on to before we start. The only thing that genuinely keeps a housing market from overheating is supply. Every band's behavior comes down to how supply matches demand at that price point. Watch for that as we go. Let's start at the bottom. Sub $300,000 in the Orlando MSA 2026. This used to be the broad first-time buyer entry point, the starter home band. Today, it's a thin slice of the market and shrinking every year. What's actually in it? Older condos in Altamont Springs and parts of Winter Park's outer edges. Manufactured homes on land. Outer ring single-family homes in Ponciana, parts of Apopka, Sanford's older sections, and pockets near the Volusia County line. Inventory is low here, but so is transaction volume. Things move when they're priced right because the buyer pool, first-time buyers stretching every dollar, small investors hunting cash flow rentals, and retirees that are downsizing, is real and active. The honest truth, if you want a single-family starter home in the Orlando metro under $300,000 in 2026, you're compromising on something. Condition, location, age of systems, or property type. That's just the math. But here's where this band gets really weird. And I'm dealing with this on a listing right now. I've got a property listed at $325,000 that's been on the market for over 6 months. Every offer comes in low, well below ask. Plus, the buyer wants closing cost credits on top. Now, here's the thing. The condition on this house is genuinely superior. Better than most of what's selling in the same area. By any objective measure, it should be worth more than what's around it. But it sits in a neighborhood where comparable homes routinely sell under $300,000. That's the punchline of this band that nobody talks about. Buyers in the sub $300K market shop by neighborhood, not by condition. They've decided this area is a sub $300K area, and they're not paying $325,000 for it, no matter how nice it is. The market doesn't reward the upgrade. The neighborhood is the cap. If you're a homeowner thinking about upgrading a property in a sub $300K submarket, that's a hard reality you need to factor in before you spend $40,000 on a new kitchen. You may not get it back. The band sets the ceiling. For investors watching, this is also the cap rate math you need to internalize. The sub $300K rental still pencils in right in the submarket, but you're working harder for it than you were 3 years ago. And if you're thinking the value add plays, buying ugly, fixing it up, renting it at a premium, the question isn't whether the rehab is good. The question is whether the neighborhood will actually pay for it. This band is the canary in the coal mine for affordability. When sub 300K disappears, the next generation can't enter the market. Now, we get to the band where most of you are actually operating, 300,000 to 500,000. This is the active middle of the Orlando market, and it's the most interesting band in the metro right now because it's not one band, it's actually two. The 300 to 400K piece is moving briskly. Days on market here run noticeably below the metro average. The buyer pool is deep. First-time buyers who saved aggressively, dual-income households, relocators landing from higher-cost states who think Orlando at 375 is a steal because they sold their starter home in Boston for 700K. They're not wrong, by the way. From their perspective, this band is a deal. From a local first-time buyer's perspective, it's a bit of a stretch. Same houses, two completely different emotional realities. Now, the 400 to 500K piece behaves differently. Days on market extend overall. Price reductions are common, but that average hides the same split as the lower tier. And I've got a buyer right now showing me exactly what that looks like. I'm working with a buyer in the 400K range. Every house they find that they actually love sells in a day or two. Every house that's been sitting on the market for a while, their word, not mine, garbage. That's the entire middle band in one sentence. Well-priced, well-presented homes are moving as fast as they did at the peak. Tired homes, overpriced homes, homes with deferred maintenance, those are the ones racking up the days on market and pulling the metro average up. The buyer's market headlines are describing the second group. They're not describing the first. Sellers anchored to that 2022 number, they're sitting. Sellers priced to today's reality and showing well are moving in 30 to 45 days. The same is true for buyers. If you're looking at the homes on the market for 60 plus days, you're seeing the leftovers, not the market. Where is the action geographically? Apopka, parts of Winter Springs, older Oviedo before you hit the newer subdivisions. St. Cloud, Claremont, Lake Mary's older inventory, parts of Sanford that aren't downtown. These are the neighborhoods where the middle band actually lives, and they're behaving differently than the headlines suggest. A Florida-specific reality punches this band in the face. A $5,000 a year homeowner's insurance premium is a small percentage of $1 million home. But on a $400,000 house, that extra $416 a month on top of your mortgage, taxes, and HOA, stack that against a 6.3 interest rate, and you've priced out a chunk of buyers who would have been transacting at this level just 2 years ago. Compare that to Texas or Arizona. Similar climates, similar growth profiles, but Florida's insurance market is uniquely brutal because of hurricane exposure and the carrier exits that we've been living through. A buyer relocating from Phoenix sees Orlando's 400K listing and thinks they've got a deal until the insurance quote lands. Then suddenly that Phoenix at 450K with $1,200 a year insurance, that looks a lot better. That's a real conversation that I have all the time. The middle is actually the healthiest part of the Orlando market right now. Not because everything sells fast. It isn't. It's healthy because it's actually transacting. Buyers and sellers are negotiating. Deals are closing. The market is doing what a market is supposed to do. The headline screaming buyer's market and the headline screaming still a seller's market are both partially right, depending on whether you're in the lower band or the upper half of this band. If you're a seller in this range, price to reality, not to your neighbor's 2022 sale, and your home will move. If you're a buyer in this range, your negotiating leverage is real, but it depends on which sub-tier you're shopping. Don't lowball a 385K listing the same way you'd negotiate on a 475 one. Very different market. Everything I just told you about the middle, it does not apply to what comes next. The 500K and up market in Orlando is operating on completely different physics. And if you're a current homeowner watching this thinking your home value tracks with the metro median, you might be in for a surprise. There's one band where sellers have more leverage than they think they do, and buyers have less than they think they do. And it's costing people real money on both sides of that misunderstanding. Let me show you exactly which band and exactly what's happening. 500,000 to 800,000. This is the I made it band for a lot of Central Florida families. Established suburban living, good schools, mature neighborhoods. Where are we talking? Oviedo's newer sections, Horizon West, Winter Garden, Lake Nona's outer streets, parts of Winter Park outside of that historic core, Avalon Park, Hunters Creek. These are the neighborhoods that define the upgrade dream for the last 15 years. On paper, this band leans buyer-friendly right now. Days on market are extended. Inventory is up. But the submarkets inside this band behave wildly different. Winter Garden stays tight. Windermere's edges stay tight. Lake Nona's core stays tight. Older Oviedo and the outer reaches of Horizons West have more give, more negotiation, and more price reductions. But here's the thing about averages. They hide the deals that defy them. I closed an $856,000 sale in Live Oak Reserve in Oviedo recently. The home was listed at $875,000. We went under contract in 3 days, my buyer competing with one other offer, in a band the headlines call buyer-friendly. Now, here's where it gets interesting. The bank's appraisal came in at $860,000. So my buyer locked up a property worth $860,000 for $856,000, under contract in 3 days with one competing offer, slightly under appraised value. That's a real win on the buyer side. But here's the lesson on the seller side. They listed at $875,000. Appraisal came in $15,000 below that. Had they listed at $850,000 instead, they'd have pulled in more buyers and probably triggered a real bidding war. They might have ended up at $865,000 or $870,000 instead of $856,000. As my buyer's agent, I was thankful for the slight mispricing. As an honest take on what happened, they left money on the table by overshooting by $25,000. The takeaway for sellers in this band: precise pricing isn't about getting the highest possible number. It's about generating the most competition. Aspirational pricing in this range narrows your buyer pool right when you need it the most. The headlines say buyer-friendly. The underlying reality is that the right house at the right price with the right preparation still moves fast. But you have to actually price it right. The buyer profile here is your move-up family, your dual-income executives, and the steady stream of out-of-state relocators carrying serious home equity from California or the Northeast. Those relocators are why the desirable submarkets stay tight even when the metro looks soft. The seller profile is changing fast. We've got a wave of homeowners who bought before 2020 sitting on enormous equity, plus empty nesters who are locked into sub 4% mortgages and finally listing as that lock-in effect fades. Both of those groups are coming to the market right now, and they're meeting buyers who think they have all the leverage because they read a headline about a buyer's market. That mismatch is where deals fall apart. Current sellers in this band have more leverage than the headline suggests. Current buyers have less. Lowball offers in Winter Garden right now are getting rejected and ignored, not even countered. If you're shopping in this band, your offer strategy matters more than it would in the middle. Now, we cross into the territory where psychology changes completely. $800,000 to $1.5 million. People stop buying houses in this band and start buying lifestyles. The geography: Dr. Phillips, Baldwin Park, College Park's premium blocks, Lake Nona's better streets, Heathrow, Alaqua Lakes, Winter Park's non-historic premium, some of the better Bay Hill streets. Days on market run longer here, but it's not a weak demand signal. It's a more deliberate buyer pool. Cash deals are common. Interest rates matter less. There's something specific happening here in the $950,000 to $1.05 million zone worth calling out. Sellers want to break that $1 million threshold. Buyers want to stay under it. That tension creates a real gap. Properties in that sliver sit longer than properties priced confidently above or below it. If you're selling in this range, your pricing decision matters more than it would in any other band. Listing at $999,900 versus $1.05 million sends two completely different signals to the market and attracts two very different buyer pools. If you're relocating into this band from a high-tax state, the Florida tax math starts to matter in real dollars. No state income tax plus the homestead exemption means a buyer moving from California, New York, or Massachusetts to Heathrow or Baldwin Park is recovering a meaningful chunk of their housing costs through tax savings every year. That's a Florida-specific advantage that doesn't show up on any Zillow comparison. For current homeowners in this band, the equity you've built is real, but the next buyer of your home is more selective than they were 3 years ago. Presentation matters. Pricing matters. The days of listing high and waiting for a bidding war are over in this range. 1.5 million and up. True luxury in Central Florida. Winter Park's historic streets, Windermere and the Butler chain of lakes, Islesworth, Lake Nona Golf and Country Club, Custom Waterfront, the top streets in Bay Hill, and Reunion. This band operates on its own physics. Low transaction volume is normal. Days on market measured in months, sometimes a year plus. It's very normal. Comps are unreliable because every property is genuinely unique. A Butler chain lakefront home is not comparable to anything except other Butler chain lakefront homes. And 3 of those might sell in a year. When you see headlines about luxury homes sat on the market for 14 months, everyone reads that as a market collapse signal. It isn't. Luxury sitting is normal. Luxury moving fast is the unusual signal. The people transacting in this band are buying with wealth, not income. International buyers, executives, second home buyers, economic cycles barely touch them. Mortgage rates barely touch them. If you're in any other band watching luxury behavior to predict your own market, stop it. It tells you nothing. Let's bring this home. There is no Orlando market. There are 5. Sub 300 is squeezed and shrinking. The middle is healthy and actually transacting. 500 to 800K is buyer leaning on the surface, but tighter than it looks underneath. 800K to 1.5 million is its own deliberate animal with real gap right under the $1 million line. And true luxury is in its own universe entirely. The median number you're seeing in headlines is lying to all 5 of those markets at the same time. Don't let it lie to yours. The supply principle holds across every band. Where supply is tight relative to demand, prices stay firm. Where supply has rebuilt, buyers have leverage. The metro average is the average of all of these competing realities, and it describes none of them accurately. So, if you're buying or selling in Orlando in the next 6 months, figure out which band you're actually in, not just by price, but by submarket. Then, tune out everything you hear about the other Orlando markets that doesn't speak directly to your band. Your decision lives there, not in the headlines. Drop your price band in the comments. Sub 300, the middle, 500 to 800, just under $1 million, or luxury. And tell me what submarket you're watching. I'll tell you what I'm actually seeing on my end, and I'll be more useful than any headline median ever will be. 5 markets, 1 metro. This has been the Florida Real Estate Insider. I'm still Tom McNamara. See you in the next one.